Putting enough money together for a down payment to buy a house is the biggest obstacle for most home buyers. But how much do you really need? How much is a down payment on a house? Let's talk about it. Since most people don't have enough money to pay cash for a home, they try to save up as much as they can for a big down payment. But the days of most people making a 20% down payment are over. In fact, the research shows it's about half of that. According to the National Association of Realtors' most recent studies, the average down payment across the board was 12% for all home buyers. First-time home buyers put an average of about 7% down, and repeat home buyers put an average of about 16% down. So the question is, if you're not paying cash, how much of a down payment do you need for a house? The answer to that question depends on many things. It depends on your finances, how old you are, if you're married or not, the strength of your credit score, and how much you've been able to save up to this point to buy a house. The thing is, there are a lot of false impressions around the topic of down payments. Due to traditional mainstream thinking, many people think down payment requirements are much higher than they really are. Look, at one point, 20% of a home's value was the typical down payment required. But home prices are so high now that 20% is out of most people's reach. To say that you need 20% down to buy a house now is just not true. There are now several loan program options available to buy a house for a lot less than 20% down. Much less. The amount of down payment required is going to depend on the type of loan that you get. So let's take a look at those different loan options. First are conventional loans. This is the standard type of loan that you'll get when you apply online or you walk into your local bank or your credit union. And most of the time, these loans have a fixed rate, which means that the rate is going to be the same for the entirety of the loan. Provided you qualify, the minimum down payment requirement for these loans can be as low as 3%, which is doable for most home buyers. Then you have FHA loans. These are backed by the Federal Housing Administration, FHA, and they require a 3.5% minimum down payment. 3.5% is the minimum. You can obviously make a higher down payment, like 5% or more if you'd like. Then you have VA loans. These loans are guaranteed by the U.S. Department of Veterans Affairs, VA. They're for people in the military, veterans, and their surviving spouses. They offer really low interest rates, and there is no down payment required for those that are eligible. That's right, zero money down. This is probably the best loan program available. I mean, gosh, I think if there's anybody that deserves zero money down and low interest rates, it's the men and women that have served our military. And then you have USDA loans. These loans are guaranteed by the U.S. Department of Agriculture's Rural Development Program. So the property needs to be in a designated rural area, and there are income restrictions. Now, similar to a VA loan, there is no down payment required. Now, obviously, you're still gonna have to pay for your closing costs though. To get these types of loans, you simply borrow from a regular lender, and the FHA, VA, or the USDA will back the loans. So why all the fuss about 20% down? Well, it's more favorable to lenders when you put 20% down because you have more skin in the game compared to somebody who's putting less money down. And the reason why is because you're using more of your own money to buy the home instead of more of the bank's money. So lenders are going to reward you with a low interest rate in general compared to somebody who's putting less money down. Now, even though you don't have to put 20% down, lenders still prefer it because it minimizes their risk of losing money. Lenders want to minimize their risk at all costs. God forbid you default on your mortgage, the bank will still be able to sell your home and recuperate their money plus any fees when they sell it because you'll have already paid down the value of the home by 20%. On the other hand, if you can't afford to put 20% down, you'll have to pay private mortgage insurance, also known as PMI. Now, this will increase your monthly payment. Lenders require PMI for buyers that put less than 20% down when purchasing a home as a form of insurance. In this case, if you fail to pay the lender back and you lose your home, they'll still get paid through the private mortgage insurance. Now, depending on the mortgage and size of your down payment, also the loan term and your credit score, the cost of PMI can range from 0.25% to 2% of the loan amount per year. Obviously, the higher your risk, the higher your percentage will be. Having PMI isn't the end of the world though, because you can have it removed later on. Once you have 20% equity in your home from paying it down and/or market appreciation, you simply call the lender and let them know that you would like to cancel your PMI and they'll assist you with that. It's important to note though that you're gonna have to take the initiative on this and call them because banks, they're not gonna call you to let them know that you can stop paying them this extra money. Now, since having PMI will increase your monthly payment, you might decide to put 20% down. So is it worth putting 20% down? Well, if you have the extra money and it's not going to put you in a tough spot financially, you might want to consider making the investment of 20% to get the best loan terms. Then there's the other school of thought that says, if interest rates are low, you want to put as little money down as possible because you'll be able to keep more of your own money in the bank in case of an emergency, or maybe you can invest that money somewhere else for a better return. So for example, if you're buying a house for $800,000 and the difference between 5 and 20% is $120,000, instead of tying that money up in a house, it might make more sense for you to invest it to grow your business if you have one and make more money in the long run, or maybe to put that money to work for you and invest it in the stock market. Another thing, when you put more than 20% down, you'll be viewed as a more favorable buyer to a seller in general compared to someone with less of a down payment. So, will putting less than 20% down decrease your chances of having your offer accepted in a competitive market? It could. The reason for that is many sellers believe you're more likely to be approved for your loan to close escrow if you're putting more money down. But it's not always true. A buyer with less of a down payment doesn't necessarily mean that they're less qualified than a home buyer with a larger down payment. So it's important that your agent communicates to the seller that you're putting less down by choice and not out of necessity. Look, there are a lot of different opinions about how much of a down payment is the best. Ultimately though, you're gonna have to decide what you're comfortable with. It's important to note common sense. If you're putting 20% down and it's gonna wipe you out financially, then it makes more sense to make a smaller down payment of 3, 5, 10, or even 15%. You obviously want to make sure you still have more than enough set aside to enjoy your home in comfort, to pay for any unexpected home repairs or any life emergencies, God forbid. Now, don't mistake earnest money deposit or EMD for a down payment. See, when you get an offer accepted and you open escrow, you're going to be required to transfer your earnest money deposit or EMD to an escrow company. This shows the seller that you're serious about buying the home and essentially takes your home off the market, but it does not stop them from accepting backup offers if they choose to. Now, sellers are going to expect to see an average of about 2 to 3% of the purchase price as the earnest money deposit. The reason I bring this up is because it's very common for buyers to mistake earnest money deposit for a down payment. They're not the same thing. The down payment is how much of your money you're paying toward the purchase price of the home, and the rest is how much you're going to be financing through the lender. So if you're putting 20% down, the lender will be financing 80%. The earnest money deposit is different. It's a deposit that gets applied toward your down payment at the time of closing. So for example, if you're putting 20% down and you've already given your earnest money deposit of 3% to the escrow company, you would need to pay the difference of 17%, which is 20 minus 3, to close escrow plus any closing costs. So how much should you put down on a house? Well, ultimately, you're going to have to decide how much is right for you based on what we just covered and your own situation, because nobody knows or cares more about your finances than you do. Just don't get caught up in the misconception that you need more than you really do, because you don't need to put 20% down if your finances are aligned. I can't tell you how many people have put off purchasing real estate because they were relying on old information when they could have bought sooner if they were just informed. So if you know anybody that would benefit from this information, please share it with them. Who knows, it might change their life. And if you're gonna finance a home, watch this video to find out the difference between being pre-approved and being pre-qualified for a mortgage. Thanks for watching.